So the Bitcoin energy market. So just a little introduction on me. My name's Gagnon. I'm the chief mining officer at a company called Bitfarms. Bitfarms is one of the largest and oldest publicly traded Bitcoin mining companies in the world. We power just under 2% of the Bitcoin network in 10 facilities in 4 countries. And we've been operating since about 2017. We've done this primarily in Quebec with hydropower, so we've done over 20,000 Bitcoins just with hydropower alone. And we are now expanding into Argentina, so we're also incorporating a little bit of nat gas into our portfolio as well. Today, I'm just going to talk to you about energy and Bitcoin and talking about hash price in units of energy. It's not something that I think people really talk about a whole lot, but it helps to contextualize what Bitcoin mining is and how you make money with it when you're converting energy, when we're expressing in their native units. So the first thing, why is this even important? As a Bitcoin miner, we all know we do not control our revenue. Bitcoin mining difficulty and Bitcoin price come together in something called USD per terahash, or our hash price. These are 2 factors that are out of everyone's control. What your computation is worth is a function of market demand for Bitcoin and the market competitiveness on the network. There is no real way to hedge this out at scale right now, although products are starting to emerge that will help you manage your revenues in the future. What we can control as Bitcoin miners are cost, okay? And our primary costs come from our watt per terahash efficiency and our price per kilowatt hour. And these 2 combined come into also a USD per terahash figure, but it's cost-based, which of course leads us to our direct profit. Very, very simple calculation. The reason why you shouldn't use a separate calculation for, hey, what's going to happen with our Bitcoin mining economics if Bitcoin price goes up $5,000 every single month for the next 12 months and difficulty does 5%? Well, it's not real. The way that these numbers combine, they help to kind of self-heal each other as they go back and forth. And so as price goes up, hash rate goes up, generally speaking. As Bitcoin price goes down, hash rate can often come down, right? Especially when we're at the floor. So when you have a cost to operate your equipment that is greater than the revenue that you're generating, you should be turning off your equipment. Now, there's some certain situations where people aren't doing that, but generally speaking, that's what it looks like. And so here on this chart, what you see here is that the green line is the combination of the 2 blue and purple lines. And it's a kind of a smoothing out effect when you have these 2 numbers that are working against each other to come into this equilibrium here on hash price. On our cost, we have 2 primary factors, which is, of course, our watt per terahash efficiency and our cost per kilowatt hour. And what you see here on the chart is a break-even watt per terahash over time at different electricity prices. So you've got 6 cents there in green, then you've got 4 cents in blue and 2 cents in purple. And what you can see here is that your cost per kilowatt hour is way more impactful on your cost to operate your equipment than the watt per terahash efficiency is. And a lot of people get really obsessed with your watt per terahash efficiency. You think you need to upgrade your machines, you need to have the newest machine all the time. For most people, buying the newest equipment and paying a premium for it is not actually how you generate the most profit and the best ROIs. You actually want to not pay a premium. You want to focus on reducing your costs on the kilowatt hour side and buying cheaper equipment on the watt per terahash efficiency side. And that's basically what this chart is showing. Watt per terahash is very important, but your cost per kilowatt hour is infinitely more important than your energy efficiency. But those 2 numbers combine into your cost per terahash. It looks a little bit like this. This is broken down for a variety of equipment right now. This is taken out of spot price at March 25th when I was doing this. And you have your watt per terahash efficiency there at the top for various models. You've got the S19 XP down to the WhatsMiner M20S. And then you have your cost per kilowatt hour there on the left. Generally speaking, I think 4 cents is a competitive rate. that most miners should be aiming for. You want 4 cents or less, generally speaking. There are exceptions, but that's where you should be at. And how that turns into your cost per terahash comes out there in that scaling chart. And what you can see is that even if you're operating the best equipment, the S19 XP, and you're operating at an 8 cents contract, you have a 4.5 cent rough cost to operate that equipment. That is the same as having a Watts miner, which is significantly less efficient at 5 cents, right? It's much, much more important for you to focus on your costs. Much, much more important. And when you break down your costs, it roughly comes out to this for most miners: 80-90% electricity, somewhere between 5 and 15% for operating, 5 and 15% for overhead, general administration expenses. Also, if you are exceeding these ranges by a large amount, something is wrong in your business model. If you've got power costs at 40% and your admin is at 50%, you're spending way too much money, right? Maybe you cut back on your sponsorships or your parties, but this is how we're competing. And so when you think about this now as what that miner can actually do in terms of electricity, this is what the revenue works out to on a kilowatt hour basis for 3 models. I've got out there an S9, which is kind of the old workhorse of the day, as well as the S19J Pro, which is a good majority of the market now, and the most efficient, the S19 XPs. It should be noted that the XP did not exist at the beginning of this chart, which is 3 years of historical data. So there's a little bit of discrepancy there, but this is how the chart works. You have roughly a conversion effect. And when you think about Bitcoin miners and what they are, they're energy buyers of last resort. They are the people who are willing to come in and buy your energy when nobody else wants it, nobody else is willing to move there, nobody else is willing to make the investment. And so the question then becomes, what is that energy buyer of last resort worth? What are those economics? And this is how it works out on a per kilowatt hour basis. When you look at what average prices are for kilowatt hours in whatever market that you're operating in, you should be comparing it to this chart to give you a base indication of whether or not this is even viable or worthwhile for you to do, right? If you are an energy company that has excess production capacity and you know your generating costs on that electricity and it's significantly below this, there's a market for you that's greater than your existing market base that you can tap into that doesn't require customer demand in real time. It's a flexible load. It can be a permanent flat load if you want it to be. But this is what this can do to your energy economics. You can start getting 16 cents a kilowatt hour. You can start getting 20 cents a kilowatt hour for the energy that you're selling when the energy market might only be paying 8 cents or 10 cents. It's not infinitely scalable, but in small amounts of your business, it can be very, very valuable and very meaningful to the bottom line. We can do the same thing here, and this is done in coal tons. So this is hash price expressed in coal, the weight and value of coal per ton. And the interesting thing about this here is that the implied value of converting Bitcoin from coal at current prices is basically not profitable. And for a good section of time over the last year has not been profitable at all. And so there is a lot of concern out there about the coal emissions and all the people who are operating on coal, and the industry says, well, we're actually not using a whole lot of coal. We're actually using a lot of renewables because the incentives on an economic basis for renewables are a lot better. But of course, we get judged for the negatives and not for the positives in this industry, and so we get associated with coal. And the reality is, coal is just not very competitive anymore in this energy space, and this is very much indicated here by the equivalent in coal prices per ton. It is negative for most of the last year, and right now it's barely profitable. Nat gas is a little bit of a different story. And up here you have different conversion efficiencies on the nat gas side of things, right? The equipment that you're using to generate electricity from nat gas varies. I put in 35 there for like a general genset, 40 for a general turbine, and I put 60% up there for a combined cycle. So you get an indication of what a MMBTU of gas is worth in Bitcoin mining if you're converting it. All these numbers are done with an S19J Pro, so you're talking about 29.5 watt per joule efficiency. And you can see that nat gas, in converting it off compared to Henry Hub, the price that you can sell your nat gas is incredibly profitable. There is a huge, huge gap between what you can sell your gas for to Henry Hub versus what you can sell your gas for to the Bitcoin mining market. Massive, massive gap. But the gap gets really tight there over the last year. Why is that? Gas price went up, Bitcoin mining economics went down. And so those margins got really compressed. The good times that everyone had in 2021, they largely went away as the price went up in 2022 and Bitcoin mining economics went south. And so while it can be very attractive, especially in certain peaks of times and certain periods, there's also a risk to your Bitcoin mining business that you're not in control of your costs anymore. And if you're not in control of your costs and you're not in control of your revenue, you're not in control of your business. And so you need to understand this curve, and you need to understand either how to manage this cost, or you need to find a different source of energy to utilize. The next one I have here is hash price expressed in units of uranium-235. So this one is the most interesting by far. Uranium is incredibly cheap per pound, but what it can generate per pound of uranium is in the thousands of dollars. A pound of uranium is roughly $50. It can generate anywhere between $2,000 and $10,000 per pound of uranium. So what does that tell you about energy markets and Bitcoin mining, where it's going to go? It tells you two things. One, we're all profit maximalists, and because we're all profit maximalists, we actually don't want coal, and a lot of us may not want gas. But things like uranium and nuclear power, these are going to be very, very interesting power profiles and power sources for Bitcoin miners in the future. It's stable, it's low cost, and if you can see the relative efficiency gain from that fuel, it's by far the biggest margins. There is the most potential in nuclear of any energy source out there right now. There's also good opportunities in things like hydro and geothermal as well, but nuclear is probably what's going to be powering the Bitcoin mining industry in 20, 30 years. And it would be very surprising if anything else has enough bandwidth in that margin to justify the economics. So that's it. Bitcoin mining, hash price expressed in energy units. I hope that was interesting. If you have any questions, if you have energy you'd like to turn into a Bitcoin mining site and you think it's competitively priced, contact us, reach out to us. We're happy to take a look and consult or advise or work with you on the project. Thank you very much.